US labor market remains on a solid footing, but uncertainties still remain. RBI's moves should unleash the Indian economy, and why I'm bullish on Alphabet. This is Vinay Uttam, your resident stock doctor, and welcome to a brand new episode 131 of the Stock Doctor podcast. No, I'm going to be very upfront already. I'm going to already say, I'm going to put it out there. I'm not here to talk about the spectacular but not surprising implosion of the world's most powerful bromance between President Trump and Elon Musk. You've seen Tesla lose $152 billion in market cap in one day, a worst drop in its history, the worst probably drop in corporate history for any company for that matter. And if you're not a Tesla investor, I'm sure you've seen the memes and had your entertainment and enjoy the popcorn with it. No, in the grants, but I'm not going to hear. I'm not, there's a finance show. It's not a political show. All I'll tell you is about Tesla stock. All I'll say is, in the grand scheme of things, is that the President Trump's big beautiful bill passing in its current format at the Senate has become even more likely. Although President Trump continues to have more backers compared to Mr. Musk, it's become even more unlikely. However, if not impossible, although the current bill, the big beautiful bill, as they call it, is in its current format, the format that got passed in the House, I talked to you about a couple of episodes back. That was never going to happen. It was never going to pass in the same format based on every single commentary you hear from senators. They would like to make their changes, and then it goes back to the House, and the merry-go-round just goes on and on and on. Typical Capitol Hill. Nothing's nothing's changing that. At the same time, as investors, all we can do is make sure that this drama doesn't derail the big beautiful bill entirely, as lower taxes and deregulation were the expected catalyst that would counter to an extent the negative impact from tariffs. And right now, as things stand, ladies and gentlemen, the tariffs are kicking everybody, investors, stakeholders, customers, suppliers, everybody's asses. That's for absolute sure. So we are hoping at some point, as investors, all we can hope is the deregulation gets unleashed, lower taxes come in, lower corporate taxes come into play, that would spur growth to an extent that it somewhat mitigates the uncertainty or the negative impact of the tariffs. As things stand, though, it's tariffs who are winning this battle. Now, apart from the drama that not even Hollywood could have imagined, although that drama has subsided since then. I think it was a 24-hour slugfest on X and Truth Social, respectively. But it has subsided for a bit. I think President Trump's latest comments is like, "I'd like to move on. I'm not even thinking of Elon. Elon's been very disrespectful, blah blah blah." And we haven't heard much from Mr. Musk either. So apart from the drama that not even Hollywood could have imagined, like I put it, has subsided to an extent. There were positive developments, though, last week in the form of some progress on US-China trade talks. And any progress, ladies and gentlemen, no matter how small, is always good when it comes to both US and China. And there was also a better than expected jobs report. So once the dust had settled, once you had finished your popcorn and looked at the events of the week, it was a positive week for stocks overall, except if you are a Tesla investor, in which case, well, things didn't clearly work out for you. All three indices ended well in the green, Dow jumping 1.2%, the S&P 500 jumping 1.5%, and the tech-heavy NASDAQ finishing the week up 2.2%. Within the tech-heavy NASDAQ, Microsoft has done a fantastic job. I will be talking about dissecting Microsoft in the weeks to come, but it had 8 consecutive sessions of green, and it's just hit a record high yesterday. So within the Mac 7 seems to be, the wheels keep going positively forward as far as the Mac 7 is concerned, stocks are concerned. So let me welcome you to the Doctor's Weekly Snapshot and discuss the other key developments that took place in the week gone by. Those that are more vital for investors, in my opinion, unless, of course, you are a Tesla investor, in which case I've already told you that the spat between President Trump and Elon Musk has subsided, and Tesla has shown some signs of clawing back the $152 billion, disaster of a day, the losses that it suffered on that particular day. But as far as non-Tesla investors are included, and of course even Tesla investors should be bothered by this, or should be affected by this, is that there was a lot of labor data this week in the US markets. And if you take the overall picture, then as an investor, you have reasons to cheer as well as worry. It was like Peter Bookwas, so now someone who I follow, and he regularly comes on CNBC's Fast Money. He's the CIO of Bleakley Financial Group. Someday I hope to have him on the show. I mean, he called it a very confusing jobs report, and I think that summed up perfectly well, in my opinion. I think that I don't think I could have put it any better. So firstly, the US added 139,000 jobs in May, which was above economists' expectations of 125,000 jobs, but it still signals a slowdown from previous months. You see the confusion's already coming, conflicting sentiments already coming. This indicates employer caution and ongoing uncertainty, particularly regarding tariffs. The unemployment rate, though, remains steady at 4.2%, so it's remained unchanged. On the face of it, this is good news. But when you actually dig deeper, then you will realize that this steady rate actually masked a sharp drop in employment in the household survey, largely due to a decline in labor force participation rate. So labor force participation rate, without, if you don't really dig deep, you would actually miss it. But the labor force participation rate has actually declined from 62.6% to 62.4%. Now, while that 0.2% might be small in terms of percentage, in absolute terms, it's a lot. Okay, a sharp drop in employment, and that's nearly 700,000 drop in the employment figure in the household survey, which is a separate survey from the jobs report. So while 4.2% remains steady, you're seeing unemployment remaining steady, there's something brewing in the backdrop, and that's something that probably investors need to pay a lot more attention than they would otherwise. And here's the kicker. While the May data was solid given the circumstances, obviously we're going through living through a period of uncertainty and so on. So given the circumstances, the May data report, labor report was solid. Revisions actually, so the April jobs report, March jobs report, all of that showed that the jobs market was weaker earlier in the year, much weaker earlier in the year than previous thought. In fact, employers added 95,000 fewer jobs in March and April combined than initially report. The revised April jobs number was actually 147,000, and it was down from 177,000. So one can only imagine when the June labor data comes in, what would be May's revision? Because we're still going through the uncertainty. We're still going through periods of uncertainty, right? Now, this is why I'm telling you, Mr. Bukwar is absolutely right when he calls the jobs report a very confusing one, because these are very confusing signals indeed. And a lot of it has to do with the labor market being described as low hiring, but low firing environment. In other words, employers are adding fewer jobs, but at the same time, layoffs are not occurring at a rapid rate in the US. In other words, you have a job in the US, you're fine. But if you're looking for a new job, just like me, well, but I'm looking elsewhere. I'm not looking in the US. But if you are one looking for a job in the US, then you are you are going to find it a lot harder. I'm not saying things are any easier here. Okay, that's a different story. Based on my experience, been absolute brutal experience finding a job. But this is finding a full-time job. But therein lies the situation. When the US, while this May labor data report and unemployment rate study seems all seems fine on the surface, when you actually dig deep, things are a lot murkier, and that is because we now seem to be living in a low hiring but low firing environment. So in other words, there are no definitive signs of a serious downturn, but at the same time, something's not right here. Okay. Now, what markets did was markets focused on the fact that they focused on the no definitive signs of a serious downturn. So, labor market steady as far as low hiring, low firing environment. Markets like the low firing environment bit. Forget the low hiring bit. They like the low firing environment. And that's why on Friday, they reacted positively because given everything we have going right now and with the kind of uncertainties that show absolutely no signs of abating, things could have been far worse. So they decided to look at the half glass full. And that's why you saw a very positive market reaction on Friday, despite the things not being exactly as rosy as they initially seem on the surface. The fact that the labor market remained relatively steady was more than enough for investors to remain optimistic and drive stocks up. Now, speaking of uncertainties, one of the biggest uncertainties was addressed last week to a certain extent. Okay, there is still a lot. I mean, it's not fully gone, but to a certain extent, one of the biggest uncertainties was addressed last week, and I'm talking about an all-important call between President Trump and Chinese President Xi Jinping. The call focused almost entirely on trade matters, thank God, with both sides seeking to ease tensions that had escalated since a May truce in Geneva. This truce had temporarily lowered tariffs, but each side accused the other of not fully honoring the agreement. And I talked about this last week, right? I talked about U.S.-China trade truce showing signs of unraveling. Now, the U.S. obviously, like I said before last episode, accused China of slowing exports of rare earth minerals, while China accused the US of imposing new export controls on high-tech products and threatening to revoke visas for Chinese students. In what I found to be a positive move, both sides agreed that their teams would hold a new round of negotiations in London, and those round of negotiations took place yesterday in London. The Chinese team was going to be led by Vice Premier He Lefeng, who is instructed not to make concessions without reciprocation. The US team will now include Treasury Secretary Scott Bessent, US Trade Representative Jamieson Greer, the duo who went to Geneva to hash out the first phase of the trade deal, or at least rested in the past. But in addition to these two gentlemen, they will also be accompanied by Commerce Secretary Howard Lutnick, and that's a positive sign because Mr. Lutnick and the Commerce Secretary Lutnick and the Commerce Department is responsible for the export controls. So essentially, it simply signifies or simply signals that President Trump is ready to talk about export controls with China, possibly leading to some form of agreement, hopefully. For the sake of the markets, for the sake of the trade, for the sake of the U.S. consumer, we really hope something works out, something can be hashed out in in London. Like Secretary Lutnick's, like I said, Secretary Lutnick's inclusion suggests Beijing may be seeking a direct channel to the cabinet member overseeing the export controls, which is very, very crucial to these trade talks. But obviously, the US and China trade war is never straightforward. Keeping in line with this tradition, there were conflicting accounts on how the call between President Trump and President Xi went. While President Trump portrayed the call as positive and claimed progress on rare earths, Beijing's official account was less conciliatory. Xinhua news agency reported that President Xi urged President Trump to remove negative measures disrupting bilateral trade, but that news agencies made absolute no mention of rare earths. Of course, it can never be straightforward between these two nations, and therein lies the most frustrating part, ladies and gentlemen. Whatever happens on Monday, one thing's for sure, it's very unlikely we're going to get anything concrete. I mean, I would be shocked if we did. Any positive tone would be enough for us to send markets up again, but even investors are not foolish enough to know that everything's going to just be hashed out in London. No, it's not. This between US and China, things are never ever straightforward. And it is this kind of uncertainty that is going to make the summer extremely uncomfortable for US investors like you and I, who have been, who've been waiting to see some kind of resolution in the tariffs, some form of resolution for the bills, and so on. Put simply, the US economy is now at a crossroads with a potential for either continued growth or a sharp downturn, depending on how these risks play out over the summer. The risk of the big beautiful bill getting passed, in what form it takes, risk of tariffs, the risk of trade uncertainties, risk of reciprocal tariffs making a comeback, blah 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 blah. You know the drill. You know the things I've talked about in the past few weeks, and probably possibly months. All of those risks, how they play out on the summer. Now, economy's fate largely depends on consumer behavior. As long as US consumers continue to spend, risk of recession remains low. The direction of the economy is highly sensitive to trade policy decisions. If the administration stabilizes tariffs, expansion could continue for several years. If uncertainty persists, economy could fall by early next year. At the same time, while the labor market for now remains relatively solid, all it would take is for one company to begin laying off people, and the domino effect shall begin. Competitors may follow suit, leading to a rapid increase in unemployment. For now, investors are adopting the glass half full approach. But this is based on the expectation that the big, beautiful tax bill will pass, trade deals will be done, and more importantly, the labor market will continue to hold up without breaking. And of course, they also expect the Fed to make a couple of rate cuts in the second half of the year, especially towards the end of the year. I like the optimistic view. I like the glass half full view. So should you. It's been driving the markets up for now. As it means markets will continue to go up, and as long as this optimistic view holds. But realistically, that's a lot of assumptions that markets have factored in to be optimistic. All it would take is for one of these assumptions to fail, and everything else would collapse, and the markets would, forget along with the economy, markets would also tumble. We've already seen this. This is already seen. Investors have got, it's very easy to forget the short term. Remember what happened with on April 2nd and April 3rd and April 4th, right up till April 9th when President Trump finally paused the reciprocal tariff. So all it would take is one of these assumptions that I've mentioned in the last 30 seconds to a minute to fail, and that's it. Everything else would collapse. This reality is what investors need to concentrate on going forward, not the Hollywood drama between the world's most powerful man and the world's richest man. On that note, let's head to the next segment, Doctor Goes Home, where basically it's more positive news. If last week, and last week on Dr. Goes Home segment, I talked about the Indian automakers, about the sales figures and so on. The week gone by was certainly belong to the Reserve Bank of India, as the bank demonstrated how far it's willing to go to turbocharge the growth of the Indian economy. In case you're wondering what I'm talking about, last week was when the RBI's Monetary Policy Committee, MPC, met to make a decision about interest rates, and what happened was something that is unprecedented. The Reserve Bank of India cut its key repo rate by a larger than expected 50 basis points. The expectation was 25, bringing the repo rate down to 5.5% as opposed to expected 6%. This marks a third consecutive reduction in 2025, totaling a 100 basis point cut since February, when the first cut since May 2020 was implemented. The RBI also slashed the cash reserve ratio for banks by 100 basis points to 3%, further enhancing the banking system liquidity. Now, cash reserve ratio, put simply, is the minimum percentage of a bank's deposits that must be held as reserves at the central bank, either in cash or as deposits. So by slashing it an entire 1%, it simply means banks have a lot more cash to lend, right? Cash to undertake lending activities. And the rationale behind the move being the excess liquidity should lead to higher corporate activity, thereby turbocharging the economic growth. It's as simple as that. So cash reserve ratio, not much to, not much math there. It's simply the minimum percentage. And as long as the minimum percentage goes down, that's more money for lending, more money for lending, more corporate activity, more growth. Cycle complete. The move also indicated that the RBI, in its opinion, has done its bit for now. Basically, based on Governor Sanjay Malhotra's comments, I think it's been I think the Reserve Bank of India, in its opinion, is we have done enough for now. And investors shouldn't expect any more rate cuts unless data suggests otherwise. This is because, now this was further evidence because the central bank changed its monetary policy stance from accommodative, which means more rate cuts possible, to neutral, indicating that future policy actions will be data dependent. Investors still expect RBI to make a couple more cuts towards the end of the year, but for now, don't expect any more don't expect any more freebies, or don't expect any more such generosity from the Central Bank of India, the Reserve Bank of India, because at the end of the day, when you change from accommodative to neutral, it clearly indicates that you have now become data dependent and you're going to be very cautious. So why did the RBI take a metaphorical chainsaw to interest rates? Simple answer: cooling inflation. Muted inflation provided the RBI with space to focus on supporting economic growth. The inflation outlook for the year was revised downward from 4% to 3.7%. Remember, it's 2 to 6. Yeah, the bracket is the RBI's target range is 2 to 6%. So when you look at the midpoint, it's 4. And if your inflation outlook is below 4, then you can go ahead and cut rates because it's a benign inflation. The other reason is lagging growth. RBI retained its GDP growth forecast for FY 25-26 at 6.5%. Growth, while resilient, is described as lower than the bank's aspirations amid global challenges and heightened uncertainty. Put simply, this was a clear case of front-loading rate cuts to revive growth. And the muted inflation, along with an above-average monsoon, which should help to keep inflation muted, allowed the central bank to do the front loading without having to worry about growing inflation. If you haven't been following the show recently, you would notice that this is a very stark contrast to what's been happening in the US, where the tariff policies have threatened to raise inflation, again, leading the Fed to take a more cautious approach. Now, having said all of this, this was the positive bit. Risks to inflation do remain, and that's largely because we still don't know how the reciprocal tariff saga is going to end. Should the first phase of the US India trade deal not conclude by July, and there are signs that it might not conclude by July, then there is a possibility that the tariffs might might make a comeback, which raises the risk of inflation growth. Remember, India was charged with 26% reciprocal tariffs, so could make a comeback. There are also geopolitical uncertainties that are looming as well. So when you take all of this into account, one can clearly see the logic. As an investor, you can clearly see the logic behind the RBI's decision to revert its stance from accommodative to neutral. There were some other positive data points as well, specifically coming in from a couple of RBI surveys. One such survey said urban consumers in India are showing stable confidence in the current economic environment and have a significantly brighter outlook for the future. Concerns about inflation and prices are easing, and while current spending is cautious, expectations for future spending and earnings are positive. The latest rate cuts and cuts in the cash reserve ratio should help the consumer confidence to grow, in my opinion, which bodes well for future consumer spending and, by extension, economic growth. The other survey, the other RBI survey was conducted was the Households Inflation Expectations Survey, which also showed some positive trends. More specifically, the survey showed a marginal improvement in inflation sentiment among households, indicating greater confidence that price pressures are indeed moderating. Having said that, a majority of the respondents do see food prices rising in the next 3 months, which is probably the only negative in the survey, given that the food prices represent 50% of the CPI basket. So inflation expectations can sometimes be a self-fulfilling prophecy. So that was the only negative, so to speak. Given the inflation expectations are indeed moderating, it should result in a rise in overall consumer sentiment going ahead, which should once again, thanks to rate cuts, lead to increased spending and, by extension, economic growth. So increased consumer lending, increased lending activities, increased consumer sentiment, increasing consumer spending, all of which should lead to higher economic growth. And therein lies the logic of the Reserve Bank of India cutting down both the cash reserve ratio as well as the interest rates as well. Bottom line, the RBI has sent a very clear signal to every market participant and stakeholder that it means business when it comes to turbocharging growth. RBI Governor Sanjay Malhotra gave enough hints that a rate cut was on the horizon in the build-up, but what transpired was way better than expected and took everyone by surprise. The Sensex post the RBI's decision actually rose over 800 points. It's a bit down as last time I checked today. And the Bank Nifty even hit a record high. Look, 6.5% is a great figure for growth. And it puts India as the fastest growing major economy. But it's not enough for the Indian economy, for India, or not Indian economy, for India as a country to reach the promised land of Viksit Bharat by 2047. The RBI has realized that consumer spending was lagging, growth was slowing down, and given the moderating inflation, acted decisively. There is absolutely no excuse now for the government and the banking sector to not act on this, especially for the government to make sure the business conditions continue to improve so that it can continue to attract investments. As for the banking sector, whatever complaints they had about not having enough room to undertake lending should cease to exist with the latest move from the central bank. Governor Malhotra and company have given India Inc., government officials, and bank executives the resources that would unlock the promised land of high growth. How they use it, how they use these resources will determine whether the Indian economy roars back or continues to limp. For the sake of investors like you and I who invest in the Indian markets, let's hope they pick the first option. And on that note, we head to the final segment where the Mag 7 is back in contention as I dissect one of the Mag 7 constituents that's been pretty much facing a lot of heat in recent weeks. And I'm talking about Google parent Alphabet Inc. Alphabet reported its Q1 earnings at the end of April, towards the end, and the company had a very strong start to the year, comfortably beating both the top and bottom line estimates. More specifically, Q1 revenues came in at about $90.2 billion, up 14% year over year in constant currency, and beating analyst estimates by $1.1 billion. Diluted EPS came in at $2.81, up 48.7% year over year, and beating analyst estimates by 80 cents. Notably, the EPS growth accelerated once again after a blip in Q4. Operating margins were strong once again, expanding by 230 basis points or 2.3%, coming in at 33.9%. Free cash flows for the quarter came in at 18.9 billion, that's billion with a B, with trailing 12-month free cash flows now standing at $74.9 billion. That's again billion with a B. The company once again reaffirmed its capex guidance of $75 billion for 2025. Management once again reiterated that the investments in capex will remain a headwind to the bottom line for the rest of the year as a result of accelerated growth and depreciation. Management also reiterated that cloud revenue growth would continue to see variability depending on capacity deployment each quarter. Finally, management also announced that they expect some headcount growth in 2025 in key investment areas. And when I talk about headcount growth, I mean there should be increased hiring in certain areas. Those were the numbers. We now go on to the takeaways. Google's acquisition of YouTube, in my opinion, would go down in history as one of the greatest acquisitions of all time. It has been a strong growth catalyst for the company over the years, and recently the segment unlocked a historic milestone as it celebrated its 20th birthday. Today, YouTube currently hosts more than 20 billion videos, including this one, with 20 million views getting uploaded every day. 20 million videos getting uploaded every day. This video will be today one of those 20 million. Now, based on the latest Nielsen data, YouTube continues to dominate the streaming world as it set a new record for the second consecutive month with 12% of the total TV watch time, with second place Netflix well behind with 7.9% share of the TV watch time. I covered Netflix last week, so if you go into the last episode, you'll see my take on Netflix. Now, during the earnings call, management also announced that YouTube today has over 1 billion monthly active podcast users. This show, you and I, all belong to those 1 billion. And YouTube Music and Premium crossed 125 million subscribers globally, including trials. While all these records are great, when it comes to advertising revenues, YouTube is in a rut, unfortunately. The year-over-year growth has been slowing in recent quarters. Now, while Q1 saw once again ads revenue clocking double-digit growth, when one looks at recent past, then the revenue growth has certainly decelerated. For instance, the first quarter of 2024 saw YouTube ads registering a 20.9% year-over-year growth in revenues, and it has slowed down to 10.4% year-over-year in the current quarter. That's a sharp decline within 12 months. So while all these records and milestones are fantastic, at the end of the day, it's the revenues, right? And so when you have a slowdown of from 20.9, near 21% to 10.5%, that's not exactly particularly very warming if you're an Alphabet investor. Moreover, after crossing the 10 billion mark in the previous quarter, revenues once again dropped in single digits in the current quarter and came in marginally below the consensus estimate of $8.97 billion. See, milestones are great and should be celebrated. YouTube has indeed come a long way, but the recent lull in the revenue growth of the ad segment is a trend that investors definitely need to keep an eye out for, especially since its rivals have all entered the ads business as well. Second takeaway, CEO Sundar Pichai kickstarted the earnings call by highlighting how the company's AI overviews have been well received by users, with over 1.5 billion users taking advantage of the feature every month. According to a recent report from TechCrunch, the company's flagship AI tool, Gemini, has seen its monthly active users nearly quadruple in 6 months to 350 million, which is an impressive feat. However, all this user growth, unfortunately, is simply not translating into revenue growth, which shows how competitive the landscape has become for the company's search business. For instance, while revenues in the search and other segment crossed $50 billion for the second consecutive quarter, the revenue growth for the first time in 5 quarters was in the single digits. With each passing quarter, the revenue growth has been steadily declining. And the decline in search business, I mean, when you think about it, the decline in search business is not particularly great for Google. But when you really dig deep, it cannot be surprising if one actually looks at the competitive landscape. For instance, Gemini user growth might have quadrupled, but still lags far behind its competitors. Meta Platform's Meta AI tool had monthly active users of nearly 500,000 of as of late 2024. OpenAI Sam Altman earlier this month revealed that around 10% of the global population is using OpenAI systems, which is ChatGPT, as the company clocked 800 million users. Then you have others such as DeepSeek and Perplexity, which are also gaining in popularity. The point I'm making here, ladies and gentlemen, is that all of these rivals are eating into Google's share of the search business. While Google continues to dominate the search business, there is evidence that we might be at the beginning of the end of this particular dominance. Having said that, it's not all doom and gloom. The increasing adoption of Gemini and AI overviews is promising. And in addition, the AI mode, which is in beta form right now, is also being well received. Although, like I said, it remains an experimental feature for now. It is vital that the company is able to monetize these tools and revive their search business before the landscape becomes even more competitive than it is today. The promising positive, now that we're moving on to third. So one was one was YouTube, one was search business. Now we move on to third, and that's the positive one. The promising positive takeaway from Google's Q1 report was that Google Cloud continued its upward trajectory despite being constrained by capacity. For the fourth consecutive quarter, it clocked the highest revenues to date, coming in at $12.3 billion. Although the revenue growth for the segment has been on a declining trend, the growth rate continues to hover around the 30% mark, which is promising. The main issue plaguing the cloud segment is the capacity constraint, like I mentioned earlier. Management during the recent earnings call did warn about they also warned about this at the end of Q4 last year, and which they even reiterated during the recent earnings call that there will be variability in cloud revenue growth on account of capacity constraints. Now, in my opinion, what is vital is that the company continues to invest to unlock capacity, no matter what the macro environment is. With over $95 billion in cash and cash equivalents and having generated $36.1 billion in operating cash flows, the company can afford to make the necessary investments to ensure that these capacity constraints, which are hindering growth, are removed as soon as possible. So I was very pleased when the company reaffirmed its commitment to spend $75 billion in CapEx for 2025. The company, in my opinion, is sitting on a potential gold mine in Google Cloud, even as its main search business shows signs of fatigue and even rapid decline. It is therefore vital that the company does whatever it takes to unlock it, even if it means spending $75 billion in a challenging macro environment. The last takeaway and this is probably the best one, there's been a lot of fanfare surrounding Tesla's robo-taxi, so much so that before all this drama between President Trump and Musk, the stock had skyrocketed post the company's earnings, Tesla's earnings itself. After the company said it was on track to launch the robo-taxi by June in Austin, and it's actually starting next week, as far as I know. It's been up. It was up nearly 9% since it's within 2 days of its earnings release. Obviously, this is way before all the drama took place, but you can just see the hype around robotaxi, right? Tesla's robotaxi, you can already see. I mean, the earnings were pretty dismal and it was nothing very encouraging. The mention of on track to launch robotaxi service in limited format in June was enough for the stocks to rally up to 9%. So there's been a lot of fanfare as what I'm talking about. Now, I'm of the opinion that Tesla's robotaxis would be successful once they establish themselves. Although I do have my doubts in the June timeline, as in they're going to be established in June timeline. In fact, Mr. Musk in recent interview with CNBC's David Faber actually did say that he expects a very limited release of the robotaxis and then plans to ramp it up as the months and weeks go by. Investors are, in my opinion, valuing Tesla on the basis of future success of robotaxi and humanoid robotics. Now, I don't see anything wrong with that. What baffles me, however, is why investors are reluctant to give Waymo the same recognition, if not more. Alphabet's Waymo is by far the most established robotaxi service in the United States. Now, the robotaxi company currently makes over 250,000 paid passenger trips each week, which translates to a 5x increase on a year-on-year basis. What's more, the company is in Austin is already in Austin via a partnership with Uber, with plans to launch Atlanta later, which with plans to launch in Atlanta later this summer. Washington D.C. and Miami are the next targets scheduled for launch in 2026. During the recent earnings call, as a response to an analyst's question, CEO Sundar Pichai outlined that the company is exploring multiple business models when it comes to rolling out Waymo, including a scenario where consumers can own Waymo robotaxis. In another boost to its growth prospects, the National Highway Traffic Safety Administration, NHTSA, released its latest automated vehicle AV framework, which actually eases some safety rules and paves the way for an accelerated rollout of robotaxis. Waymo is currently the only paid robo-taxi service in the US, and yet, in my opinion, investors simply aren't giving it the recognition that it deserves. According to LSEG data, Tesla trades at a forward price to earnings of 109 times, with a significant portion of the valuation attributed to the future growth prospect of the robo-taxis. Surely, the company that offers the only paid robo-taxi service with a roadmap to cover the US much earlier than Tesla deserves a multiple higher than 17, right? I mean, I don't get it. So it's something that baffles me. It's such a such a high performance, only being the only paid robo taxi service, and yet something that is going to be released in limited models gets far more recognition. Well, it's power of marketing. I don't know what Waymo is doing wrong. Anywho, notebook and pen ready. That can only mean one thing. We're talking about valuation, right? Now, there have not been made many major changes to the company's valuation multiple since the last time I talked to you guys about Alphabet. Google continues to be the cheapest among the sensational six. You have Alphabet, Meta, Amazon, Microsoft, Apple, and Nvidia, currently trading at a forward price to earnings of 17.6. Now, Google also continues to trade cheaply relative to its own historical multiples of 21.5, which is the 5-year forward median, and 22.5, which is the 10-year median forward median. Now, post the sell-off in recent weeks, the median forward price to earnings of the sensational six stands at 24.6 compared to 28.6 the last time I talked to you guys about about Alphabet. Since Nvidia belongs to a different sector, probably a different league, I'm excluding the company from Google's peer list, which takes the median PE multiple of the Fab 5 to 26.6 compared to 28.2, which was the median the last time I talked about Google. Now, the consensus estimate for FY25, according to LSEG data, stands at $8.81 compared to $8.94 at the end of Q4 earnings. This decrease makes complete sense to me, given that the management has continuously mentioned how the profit and loss would be negatively impacted as a result of accelerating depreciation on account of the company's capex investments, a point that was reiterated once again during the most recent earnings call. Now, as I mentioned last time I covered Google, I talked to you guys about Google. The company has a consistent track record of beating analyst estimates, and on average, the margin of the beat has been 2.9%. Let's assume the company beats the FY25 estimate by 2.9%, then FY25 EPS is projected to come in at $9.06. So the first data point that I will show you, FY projected EPS is going to be $9.06. So $9.06 is which translates to a year-over-year growth of 12.7%, lower than its average long-term growth of 17.4%. Now, given that the EPS growth, the projected EPS growth for FY25 is lower than its long-term EPS growth, I've assumed a forward price to earnings of 21.5x. Let's see, 21.5x. Yep. As opposed to 22.4x, which is the 10-year median forward price to earnings in my estimate from the last time. Now, according to Seeking Alpha, the company currently trades at a forward PEG ratio of 1.2, significantly lower than its 5-year average of 1.45 and marginally lower than the sector median of 1.17. Now, the average price target after incorporating these three scenarios, so you put a table, three scenarios, 1.1, 1.1, 1.2, 1.45, 1.17, and then you have 21.5, and then you have 9.06. right? These are the assumptions, these are the scenarios, and then you look at the earnings growth and all of that. So these are the scenarios. So you have 1.1.2, 1.45, all of that. This is the projected EPS for FY25 for the next 12 months. Sorry, projected PE multiple, and this is the projected FY25 EPS, and then you calculate the EPS growth and you get a price target, average it out. Now, the average price target after incorporating all these scenario comes out to be 228, which represents an upside of about 30% from current levels and is higher than my previous target of 206. So price target of 228, higher than my previous price target of 206. Now, despite a significant upside from current levels, I would adopt a more cautious approach while initiating a position in the name. This is because the stock has a weak momentum with an overall grade of C plus on the Seeking Alpha momentum scale. Its short-term momentum grade is also C plus, which further suggests caution while buying the name. A dollar cost averaging strategy would be the best option when it comes to Google, in my opinion. All things considered, I'm simply maintaining. I'm not upgrading despite considerable upside. I'm not upgrading it to a strong buy. I'm maintaining a buy rating on the stock with a price target of 228. Now, a bull case means I have to outline the risk factors for investors to consider. The main risk factor that would be affecting my bull case negatively is the one that has led to weak momentum in the name, the regulatory overhang, which continues to be a major problem for the company. Very recently, a judge ruled that Google has a monopoly in the areas of publisher ad servers and ad exchanges. And on top of this, the US Department of Justice is currently seeking a solution to end Google's dominance in online search, which could lead the company to divest Chrome. Now, there was even a rumor in recent times that OpenAI is interested in acquiring Chrome under such a scenario. And in addition to this, the company also faces regulatory scrutiny in Europe, and its acquisition of Wiz is far from being a done deal. The Wiz is basically the cloud cybersecurity firm that Google eventually bought out, but it's still pending. It's far from a done deal. The other risk factor is the increasing competitive landscape that I already touched upon earlier, which has only gotten worse for the company in recent weeks. There is very clear evidence, like I talked about earlier, that despite a surge in the usage of AI overviews, the year-over-year revenue growth in Google's search business has been decelerating. With the likes of Perplexity and OpenAI continuing to attract more consumers, and with Gemini user growth lagging, the future of Google's search business is one that investors need to closely monitor. Bottom line, Alphabet had a very strong start to the year, beating on both the top and bottom line estimates. The EPS beat in particular was impressive as it reversed the previous quarter's growth decline. Both the search and the YouTube advertising businesses, despite posting impressive numbers, continue to show a declining growth trajectory, with the search business in particular registering a single-digit growth for the first time in 5 quarters. The slowdown in search and YouTube is being offset to an extent by the progress made by Google Cloud, which continues to post impressive growth both in terms of revenues and margins. Capacity constraints continue to keep the segment's growth in check, which means that it is vital that company continues to invest no matter what the macro conditions are. The quarter also saw management providing some major updates on Waymo, and the future looks bright for the robotaxi service. In my opinion, investors are simply not giving the segment the recognition it deserves, especially since it is currently the only, and I repeat, the only paid robotaxi service in the US. The lack of recognition is reflected in Alphabet's valuation as well, although regulatory headaches have also played a part in this. At current valuation levels, the stock continues to remain attractive in my opinion, maintaining my buy rating on the stock. However, with weak momentum in the stock, a dollar cost averaging would be the right way to play this name. Google's search and YouTube business might be slowing, but Google Cloud and Waymo are definitely ready to take up the growth baton. That's all the time I have for you this week. If you have a specific Indian or US stock suggestion for the doctor to diagnose and dissect, do tweet me at Uttam Vinay, UTHAMVINAY, or email me on the Stock Doctor Podcast at gmail.com. Thank you once again for listening. I will see you next week. Until then, stay safe and make some money.